Hey everyone, welcome back to Corporate Decoder. Today we're diving into Sunrun's latest 10K filing, and let me tell you, this one's got a twist. It's like when you think you're getting a sunny day but end up with a thunderstorm. We'll see if Sunrun weathered it. Sunrun, as you probably know, isn't your grandpa's power company. They're all about connecting people to clean energy, making solar power a subscription service right on your roof. They aim to offer energy security and savings, but how did they fare this past year? This report covers the fiscal year ending December 31, 2024, so let's get into what really happened. One of the biggest challenges for Sunrun and really any company in the renewable energy space is raising capital. They need a constant influx of cash to keep installing those solar panels. If they can't find investors, growth hits a wall. And remember, anything that affects their ability to get funding directly affects how fast you see those solar panels popping up in your neighborhood. Also worth keeping in mind is that the tax benefits that they depend on are not guaranteed. All of this can hurt the access they have to capital and how cheap it is to borrow. Speaking of borrowing, rising interest rates are another major headache. Higher rates mean it costs more for Sunrun to finance their projects. The more it costs them, the less competitive their solar plans become. It is a bit of a juggling game. There are also regulations and policies on electricity pricing that could really throw a wrench into things. If utilities start changing their rates, especially in a way that makes rooftop solar less attractive, that's a problem for Sunrun. It's all about how they can offer savings to customers. The whole thing is that government support in the form of rebates, tax credits, and incentives are a major deal. If those go away, it would make solar a much harder sell and could harm their financial performance. Sunrun's success is also tied to its partners. They depend on these solar integrators, sales partners, and installation folks to get the job done. If those relationships sour, it is delays and missed opportunities. Supply chain is another factor. As a delay in supply can stop Sunrun from operating, it's a key factor to manage. And let's talk about their suppliers. Sunrun relies on a limited number of manufacturers for solar panels, batteries, and other system components. A shortage in solar panels will stop their operation in its tracks. There are also some laws around data privacy that could be of concern. It's also crucial they don't screw up their customers' data privacy because those fines and lawsuits add up. Here is one that is an accounting risk. Turns out a lot of their business depends on being able to find investors who want tax breaks from solar projects. If that dries up, everything gets tougher. And here is one of those real-world scenarios that is an IRS risk. The IRS could disagree with how much Sunrun claims their solar systems are worth, leading to a big tax bill and potentially shaking up their entire financial structure. With over 45% of their customers in California, any disaster in the state, be it an earthquake, wildfire, or a policy change, can have a major effect. Now let's talk financials. As of June 30, 2024, the market value of their stock held by non-affiliates was about $2.6 billion. Not bad, right? Here are some operational numbers. As of the end of 2024, they had networked solar energy capacity of 7531 megawatts. It just means all their solar panels combined could pump out that much power at once. And their gross earning assets, which is the estimated future revenue they'll get from existing customers and solar systems, was about $17.8 billion. Looking at the financials, here is a key one. Customer agreements and incentives brought in $1.5 billion, while solar energy systems and product sales landed at $532 million. But here is where it gets a little less sunny. Their operating expenses were high, especially because of a massive goodwill impairment charge. That means they had to write down the value of previous acquisitions. This led to a pretty significant loss from operations. Zooming out, they've got a net loss attributable to common stockholders of over $2.8 billion. That's a big number, so their executives are going to have a lot of explaining to do. Here's what's interesting to note about Sunrun's philosophy. Regulators may impose rules on the type of electricians qualified to install and service our solar and battery systems in California, which may result in workforce shortages, operational delays, and increased costs. This indicates that there are concerns around this risk, in addition to a strong emphasis on safety within their organization. Here's what I think. Sunrun is facing some serious headwinds. While the company has increased their customer base, the transition to tax credit transfer may have some risks with the timing of tax equity or cash equity, and the cost of capital is high, limiting future growth. But on the other hand, the long-term picture isn't all doom and gloom. The market for home electrification is only going to grow as people adopt solar and electric vehicles in the future. However, the road ahead seems to be filled with risks and opportunities. Whether they can capitalize on the opportunities and get out of the red remains to be seen. So what is the final verdict? Sunrun has massive potential due to demand. Whether they can reduce risk, improve operational costs, and increase cash flows is the question. Thanks for watching. Now that I've decoded this corporate report, it's your turn. Let me know what you think about Sunrun's future in the comments. Don't forget to like and subscribe for more deep dives into the world of corporate finance.